Hello, I'm Aaron Brachfeld. I'm going to be your teacher today. We're going to be talking about how to start your own business at the Mesa County Public Libraries. To say that the goal of teaching or learning the necessary skills and knowledge to begin a business in a half hour is ambitious is a dramatic understatement. However, since boldness and courage are frequently the most fundamental attributes to success through enterprise, it's fitting that we should at least try. We will begin with a business plan. The business plan is typically used for internal purposes to help coordinate the processes within the business. However, the method of planning itself has use to the business owners and those working in the business. Even if it's just yourself, I recommend you do undertake the process of a business plan. There is no formal or correct method to a business plan. We create the plan to present the information to those who are going to read it. If we're presenting to investors, we're going to present different information in the business plan than if we're simply using it for planning purposes for ourselves. In any case, we will begin with the directives. These come from the owners of the company, the people who are invested in the company already. This describes the business's products and services that we will be providing. Oftentimes, this can be overly vague, overly general. To say that we are in a landscaping company is not going to help us identify what we're selling to the public. To say that we mow grass, that we cut bushes, and that we rake leaves, that we provide aesthetic improvement to a property, that we improve mental health of the owners of the property, that we relieve them of the time and energy, that we make it safer for them. We identify the ways that we can actually interact with the public. With this, we understand that the directors don't actually undertake the action themselves. They provide these directives to an executive officer or several executive officers. These executives develop operational strategies based upon these directives. This includes not only legal compliance, financial accountability, and the accomplishment of various other intermediate goals to provide operational support, but also the selling of the products and the services. The executives will undertake market research and understand the demand in terms of its uses and the qualities that the consumer is looking for. This is better than looking at the demand in terms of other demographics like age. It does you no good to know that your average customer is 38 years old, female, and white. It does you much better to understand that perhaps they're using the landscaping company services for their fathers who maybe can't actually clean the lawn anymore without risking a heart attack. Understanding why people are using the product and service, understanding the quality that they're looking for, allows us to actually target them more precisely. From this, we understand that the executives don't actually undertake the actions themselves. They rely on managers. We will have so many products and services that we can supply to the public. We will have so many potential operational activities that we actually have to manage our resources. Every business is limited in terms of its time, money, and assets. These resources need to be organized in a way that maximizes not only the profit of the company in the short term, but also in the long term. The resource analysis is undertaken by managers who look at the relative strengths, weaknesses, threats, and opportunities facing the business. This SWOT analysis is the most important process of the business plan. With it, we identify where it is that we will begin operations. If we lack certain resources to accomplish certain products or services, we should not actually undertake those. If we have sufficient resources for several, then we can actually make a decision. The strengths of a business when it first starts up are very minimal. Most businesses lack money, they lack assets, they lack time, because the person who's starting the business is typically working somewhere else to help fund this. They are the principal investor. Where they do typically have a lot of strength is in skill. Typically, a person begins a business based upon their interests and experience. Perhaps they've already worked in the field. Perhaps they have studied the subject. Perhaps they have had a hobby in the area. This strength is going to be what they rely on most. Because they don't have a lot of labor, because they don't have a lot of assets in terms of personnel, we have to prioritize the use of this one asset. Yes, there are many things you're going to be having to do as a new business owner. You have to keep records, you have to make sure that the store is operational, you have to make sure that your clients are served, you have to maintain a website, you have all these different things that you may have to do for your business. However, your principal purpose is to provide the product and service. It does no good to have an excellent set of books with no money coming in to keep track of. We maximize the use of our assets, time, and money by looking at where they will earn the most. If we have certain demographics that will pay a premium for a product or service versus others that will simply pay an economy rate for the same product or service, we better prioritize the ones that will be paying us the most money. We also have to look in terms of what's most efficient. If something costs a lot of money to produce and earns relatively little profit, we shouldn't prioritize that. It's easy to look at this in terms of hunting. Everybody wants an elephant that will feed them for a year. However, hunting an elephant is difficult, and you may not actually catch one this year. It's much better to look at smaller game. You have to keep your pot filled. You're going to be eating a lot of rabbits for the first year. You might get 1 or 2 deer, but look at in terms of how you can increase cash flow right away, because that is your goal, is to build up the business so it is self-sufficient. Yes, you can work towards these larger, more profitable enterprises, but you are going to have to focus on what will feed you today. From this, we develop a startup or operational plan. We actually create an understanding of how it is that we're going to begin, where we're marketing, how we're going to get clients in the door, what we're going to be selling them. We create an understanding of step-by-step what we need to do. If there were other people involved in your business, this would be a written statement or a verbalized statement explaining what their job is, explaining what you expect them to do, giving them step-by-step instructions. Because you're working for yourself, you still need to provide these instructions to yourself, if only to understand what it is that you need to be doing first, second, or third. It's easy to get lost in the process if you don't have a clear operational strategy. It's also important at this juncture to look into legal aspects of the business. If our operational strategy is illegal, we probably should look at a different operational strategy or reconsider the strategy entirely. We have to look at zoning, we have to look at licensure, we have to look at various other considerations in terms of what it is that we need to be doing legally. We then undertake a financial analysis. Can we actually afford this? We're going to create a 3-year budget, not only of money, but also of our time and assets. We're going to be looking at how we're spending our time, week by week, day by day, month by month. We're going to see how this changes seasonally. Perhaps your business is affected by various seasonalities. Perhaps there's a lunch rush at your restaurant, but there's very little business between 2 and 5 in the afternoon. If you are the cook in that business, if you're also the server, perhaps that's a better time to allocate towards bookkeeping or other marketing. Perhaps you could organize your schedule in another way that makes sense for you. Looking in terms of time budgets is very important. We also have to create a monetary budget. We have to look in terms of cash flow. We're going to look at all the money we anticipate to be coming in. We're going to be looking at all the money we anticipate to be going out. We're going to be looking at this in terms of month by month for the first year, typically quarter by quarter the second year. It's actually very difficult to anticipate month by month, year out. A lot of things can happen. What we will do is simply multiply our monthly budget on average for that quarter by 3 so that we can anticipate what that second year will look like quarter by quarter. The third year we will simply do an annual average. This allows us to see if we're going to be in the black and when. And if we're not actually going to be recovering our investment in a few years, we need to seriously reconsider our operational strategy. These scenarios, looking in terms of how our assets are used, how our money is used, prevents us from actually discovering on accident a few years later that we are actually going to be bankrupt. It prevents us from having a disaster. We can also use this simulation to anticipate what the effect of doing different products and services might be. What if instead we focused on a different enterprise? What if we looked at a different service or a different product? What if we looked at occupational therapy instead of spa treatments for our massage therapy? What if we looked at this in terms of that? It allows us to kick this around and think ahead with clear numbers. Finally, we're going to develop an investor analysis. Is this actually worth our time? Not only which operational strategy is better, but we have to look in terms of whether or not we're going to be recovering our investment in a way that makes sense for the business. Sometimes a business will make very little money, and this is okay. Some people prefer to work for a minimum or even a less than minimum wage equivalency, but be self-employed in an industry that they enjoy. Sometimes our investor, who is ourselves, may need a better ROI. They're doing this business for the purpose of actually accomplishing financial independence. We need to have a minimum amount of income. Are we meeting that? Sometimes we want to actually make more money than we could do by investing in other businesses, whether in the stock market or by lending our money to existing businesses. When we have determined that this is actually feasible and is doable and we want to do this, we will develop a marketing plan. We will understand with market research not only exactly how much people are paying, having previously estimated, not only where they're buying it, not only where they're going to be purchasing it, but also how we're going to get our products and services to them. The fundamental component of the marketing plan is understanding our role in the production or service cycle. If you're a massage therapist, if you are an occupational therapist, perhaps people are coming into you having already injured themselves. How can we advertise our services to them when they seek medical treatment? How can we advertise our services to them while they're injuring themselves out on the trail riding bicycles? Or perhaps after they've injured themselves and are not recovering from their doctor. If we're providing landscaping, perhaps we can understand where it is in the cycle of service that they determine, maybe I don't want to be cleaning up my own lawn. Maybe I don't want to be mowing my own lawn. If we're a house cleaner, we understand why it is that they're purchasing it. Perhaps they are feeble from a surgery and they can't clean their own house. Perhaps they're just elderly and they need to have somebody help them. Their house is too big. Perhaps they're professionals. Where is it that they are coming into the production cycle, the service cycle? How do we reach them? What other businesses do they shop at? What other services do they require that are related to ours? We can then cooperate with these other competitors. I would call them colleagues because you're not trying to put them out of business. They're not trying to put you out of business. But our competitors can drive business to us. Which brings up an important point, that oftentimes the market is large enough that you don't need to have an adversarial relationship with other companies. In fact, you probably shouldn't. Working with other people in the industry, you can improve all of your craft, you can improve all of your service, and you can all make more money. Once we have a marketing plan, we're going to be looking at an efficiency plan. We understand the level of quality they're requiring. If we provide more quality than that, there's going to be a minimal return to our investment in that quality. They are already satisfied. We don't need to provide more than that. And it may cost us too much to spend that much time and money providing a superior form of quality that they don't demand. We also have to make sure we meet that quality standard also. So we don't try to overperform or underperform. We try to aim exactly where they need it. This quality and efficiency plan relates, in fact, to our process of record keeping, which I will get into next. As physics relies upon measurements of time and space by dividing days into hours, compiling these hours into years, measuring even the immense distance between stars in the humblest computations of inches or meters, and has created mechanisms by which to count seconds and standardize feet, so does the economist measure value through the use of a ledger to register the flow of money. The ledger is used to understand our business. With the ledger, we develop an understanding of not only what is happening, but what is going to happen and what has happened. We understand the value that we are producing and that we're consuming. The most important information to have on a ledger is the date. This allows us to understand whether things are growing or shrinking, how they're changing through time. It allows us to understand the cycles of business as well. Some businesses rely on a day-to-day business cycle. Some have periods of hours or even minutes. With a restaurant, you will typically have hours where you're busier, hours where you're slower. With other businesses, it may be days of the week. In other businesses, it's weeks of the year or months of the year. The date is not just for the day of the year, but to register time. Next, we develop a journal. This is a dear diary. This is literally a written note to yourself that you will refer back to when you need to review how things are progressing. Perhaps you're making notes when you first hear your clients talk about the Christmas season, so that the next year you understand about when Christmas begins. Perhaps you make a note of when you first start seeing the leaves turning yellow, so that you can be ready to start offering and advertising leaf removal services. Perhaps you notice that you have not seen your sunflowers sprout. Well, you can go back and you can see whether or not they should have been up by now by looking at past years to see if they've already sprouted by that time, or if you need to panic and plant something else and go to plan B. You can see how long it typically takes to receive a shipment from your suppliers to see whether or not you should be worried that it's not arriving, whether there's a problem with it. You can also track personal information with your clients. Perhaps there's an anniversary that you need to say happy anniversary to, or happy birthday. There's ways that you can improve customer service through this Dear Diary. The relevancy of non-categorical information is not an absolute science. This will become more precise as you develop your business experience. Try to keep these entries small so that they're easily referenced. You don't want to be reading paragraphs of information a year from now. You want to keep it probably the size of a tweet, or perhaps a few lines. Next, we organize this non-categorical information into categories. The IRS allows us to deduct numerous types of expenses, whether it's advertising, research, transportation, various costs of business. These are good categories to begin with, but we may actually want to look at certain categories relevant to our business. Perhaps we want to track a particular type of product to see whether or not that product is selling better or worse than others. Do people buy more vitamin C in November or in April? Do people typically call for leaf removal in May or in June? Do people need this product or service more or less now than they did before? Can we anticipate that we will need to stock more inventory of this? Perhaps certain menu items are being ordered more. Perhaps certain menu items are being ordered less. We can use this categorical information to create quantifiable changes in our business. We can look ahead, we can look behind, we can look and see how things are at present. Keeping track of our tax deductions is an added bonus here, because later on in the year you can quickly add up the deductions that you can take, and it saves you time when you file your taxes. These categories also are used for record keeping. Some people will take a paper receipt, put it in a paper bag, put that paper bag in a larger paper bag, put that paper bag in a closet and give it to their accountant who is annoyed with them once or twice a year. You can also snap a picture with your phone, email it to yourself with the category in the subject line and a brief description so that you can easily find it later. If you're ever audited or you have a question or you need to find a receipt for your vendor or for a client, you can actually do a search in your email for that subject, for that category, and easily find all of your records. Next, we monitor our income. This is the main reason we're in business. We like income. But here we are only monitoring money. If somebody owes us money, but it has not been collected, we are not going to register it here. We will create a separate spreadsheet for our accounts receivable. Or if perhaps we receive something in trade, we won't necessarily log it here either because it's not money. We want to register only monetary exchanges. In the same sort of way, we're going to then keep track of expenses, which are the costs of business. This is also only money. If we owe somebody money and you're not paid it yet, keep that on a separate tab. Keep that on a separate ledger. Finally, we develop a balance. This balance should theoretically equal what is in your bank account. If it doesn't, I wouldn't worry too much. Your primary job, as we discussed, is to provide the products and services to the public. Bookkeeping is important, but you're new at this and you are going to make mistakes. When you first moved out on your own, you probably lost a few socks while doing laundry. You probably lost a few Tupperware lids. Your balance, you're going to lose a few dollars in, or maybe find a few dollars that shouldn't be there. This is due to your inexperience. This is due to you focusing on other things. If you're the only one in the business, you're probably not facing any embezzlement. You're probably not facing any robbery. You're probably not facing any major problems that you need to be concerned about if the amount is small. I would simply adjust that balance and try to do better in the future. Eventually, you will be able to dedicate more time to bookkeeping and record keeping, either by hiring an accountant or by focusing more on that yourself when you're able to hire other people to provide the products and services. When you do that, just make sure that you acknowledge where you have added the money back in to balance out your account. and try to keep track of that. If you are getting worse at record keeping, try to dedicate a little bit more time. There are numerous ways you can keep your records. I recommend using an electronic form, such as Google Sheets. It's a free program online. Some people prefer Excel. There's Quicken Books. There's any number of programs you can use. Just find one that you're comfortable with. When you do this electronically, it can do the math for you very easily. Just make sure you watch your equations, because sometimes garbage in, garbage out. When you balance this out, you're going to come to an understanding of whether or not you are having money or whether you owe money. You want to make sure this is in the black, positive, because you don't want to run your account in the negative. Very straightforward. What we're going to recognize at this point is that income minus expenses is profit. Everybody loves profit. What we learn is that income can be increased through marketing. If you have a barn with various types of hay in it, it can all come from the same field, and yet one pile will be sold for $15, one pile will be sold for $25, one pile might sell for $40. The difference is that one pile is hay, one pile is Timothy hay, one pile is natural Timothy hay. Understanding the value that people get from our products and services, understanding the quality that they're looking for, understanding how they're using our products and services allows us to sell those same products and services to different clients for more money. If we understand that some clients are consuming hay for their horses, and that these horses are like pets, and that they have surplus money to invest in hay, we can probably understand why they want hay and what qualities they're looking for. They might want something that is higher quality and that they value natural Timothy hay. If there's a person who simply is needing fodder for their animals, it doesn't matter what they're buying, they just want something cheap to keep their bellies full, they may just want hay. While this hay farmer is not actually investing any more into their hay by improving it in any kind of way, we could potentially increase the quality of different products to target specific clients. We can also create different websites to target different clients. If we are having a tour business and a wedding business, chances are that we want to specifically target clients who are going to be looking for weddings, so that when they do a Google search for a wedding planner, they come up with a wedding planner rather than somebody who's doing tours and romantic getaways. If they're just looking for a girls' night out, we may want to advertise to that. We can create different doing business as, DBAs, with the Secretary of State. We can register different companies for each one of these. We can still be running them all, but then provide on Google My Business, on the Google Maps, on the websites, on Bing, on wherever it is that you're advertising your website, different products and services that we offer, or perhaps the same product and service differently. Putting an ad in the paper for hay, putting an ad in the paper for natural Timothy hay, putting an ad in the paper for Timothy hay, all at the same time will attract all three different types of clients. Just as we might put on a website one type of product or service, on a different website another product or service. If we have clients who are looking for value versus quality, we don't want to necessarily try to target them both, because if we're looking to sell ourselves as a landscaper, we may want to target somebody who wants a higher quality job, somebody who wants an ongoing maintenance of their estate, versus somebody who's just looking for help planting a tree, or perhaps somebody who just needs help mowing their lawn. Advertising to both would drive some of both clients away. We can specifically target. We can also decrease expenses by efficiency, understanding exactly how much quality to provide, understanding how to make ourselves better at our job. For example, taking our tools with us to the rooftop rather than going up and down a ladder to get each tool saves time, which is one of our constraining resources. Getting better at our job, getting more efficient, looking at terms of how we can improve our quality to the point where it's being met. We can also reduce our expenses through efficiency. We can get better at our jobs. We can look in terms of how to meet quality without overpaying for that quality. We can also look in terms of how to do our job better. For example, taking our tools with us up to the rooftop when we're repairing a roof, rather than going up and down, back and forth to the truck to get our tools. It saves time, which is one of our limiting resources. The more efficient that we become, the higher our profit, the more that we are able to sell our products and services for a higher price and make sure that we're not underselling ourselves, the higher our profit. Eventually we get to the point where we understand we can efficiently market. If we raise our prices too high, we're going to drive away clients. It's better to sell 5 products at $20 for a total amount of $100 than to sell 1 product at $80. We can also look in terms of efficiency. There reaches a point where it doesn't make any sense to get more efficient. Perhaps we bulk buy to reduce our expenses. If we bulk buy to reduce our costs, we can actually overpay for our supply if it spoils before we can use it. If we become too efficient, it can become expensive. If it becomes too expensive to continue to try to become more efficient, if our cost cutting reduces quality, if it reduces our productivity, if it increases the risk of employee theft, if it increases the risk of damage to our business, then we are actually going to lose money. But there is a way to actually reduce our expenses below zero. A negative expense is one that we have invested into assets. This is an expense that produces more profit. For example, if we have purchased a truck to allow ourselves to undertake deliveries ourselves or to haul more equipment, if we have purchased a building, if we have made a purchase so that we can actually serve our clients better, then this expense functions through an asset to increase our profit. Against this, we have to measure our liabilities. Our liabilities are those parts of this asset that we do not own. These are things that will reduce our profit. So if we have bought a building, perhaps the bank owns some of it. If we bought a truck, perhaps the bank owns some of it. We don't fully own that asset. Eventually we will own that asset, hopefully, or maybe we won't, but we do have to measure the value of that asset in terms of its liability. Assets minus liabilities is our capital, and it is far better to develop our capital than it is to develop our profit. There are 3 phases to an investment, 3 phases to a business. The first phase is always nonprofit. Think of it in terms of cows. You might feed a baby cow milk, you might give it shelter, keep it warm, it'll probably throw up on you. This is totally nonprofit, it's totally charitable. You are getting nothing from this baby cow except for grief and worry. Maybe it even gets sick and dies. You are not getting any profit from this. However, you continue to invest, and as you do so, you develop capital into this baby cow. You have put money into this baby cow, and it is worth more to you for that. Because eventually it will mature, it'll start producing milk, other baby cows. Maybe it takes care of those baby cows for you. This represents a second phase, when you do see profit, but you're still investing into this cow. You're still feeding it, you're still providing it shelter, you still provide it medicine. You are still putting money into this cow. You provide it pasture, you provide it assets, time, you provide it your resources, but you are getting some back. Finally, there's a third phase where it's purely capitalized. It's pure profit. You take the cow down and you butcher it. You get meat from it. You are not putting any more into this cow. These 3 phases of business can also be seen in terms of any investment. Perhaps you hire a new employee. There's a period where you train them and you're not getting much back from them. You're actually putting more into them than you are getting out. Eventually they develop a minimum competency, and eventually they develop a skill level where you don't have to continue to invest in them. They are a fully trained, skilled worker. The average training time in America is under a week. We need more time than that to actually return our investment. We can also look in terms of other investments. For example, if we hire a new employee, we're going to be spending a lot of time training them. They're not going to be producing a lot. They're not going to be producing more than we're putting into them. We are literally taking our time and making sure that they do their job well. It can take sometimes years to get good at your job until you develop an experience level that you have a skilled worker. This represents the investment we're putting in, and which is the main reason why we need to retain our employees, because if they quit their job, if they move to another company, we've lost that investment. Which brings us to how we organize our business. The way that we interact with others is largely determined by how we ourselves are organized. If we're a sole proprietor, perhaps we enter into partnerships or into a contractor relationship or an employee-employer relationship with others. If we're an LLC, what is our relationship to this company? There are risks, there are advantages, there are threats, there are different opportunities for every type of business organization. And these considerations ultimately impact how we grow our business. If we're trying to reduce our legal liability, if we're trying to protect certain assets, perhaps the business owns certain things that we don't. We understand that we are ourselves an employee of the business through an LLC. If we are looking in terms of owning the business as ourselves, taking on that full responsibility, perhaps they are our own assets. Perhaps they're our own products and services. Perhaps they're our own inventory. We understand that we then are the business itself. Just because you don't have anyone else working with you doesn't mean that you don't have employees. You are the first employee, and actually the most important one to consider. I often get asked whether or not a sole proprietorship or an LLC is better. The answer is that neither one of them is better. Understanding the implications of each organization is important. If we have an LLC to shield us from legal liability, but the LLC doesn't own our assets that are at risk, it is doing us no good. There are ways that a sole proprietor can reduce their legal liability as well, through liability waivers, through insurance. There's ways that we can reduce our risks, even without looking at our organization. Perhaps if you go to court, you may be facing expenses of a lawyer. Perhaps if you go to court, you may be facing consequences from a lawsuit that are not necessarily resultant upon whether you win or lose. Your organization may not actually benefit you there. Perhaps if you go bankrupt, you're not shielded because you are yourself co-signing for the loans. Understanding this requires talking to an accountant or a lawyer. Ultimately, we have to look at the organization of our business as one of its assets. This is legal infrastructure. Going back to the business plan, we can start understanding through a SWOT analysis whether or not it makes better sense to form a corporation, whether it makes sense to form a cooperative, whether it makes sense to be a sole proprietor, looking at the relative strengths and weaknesses of each type of business and applying it to our business model through various simulations. We can then examine very closely and understand what opportunities and threats each type of business faces. The opportunities that a sole proprietor faces will be different than a corporation. As a sole proprietor, you are much more free to undertake your own bookkeeping, undertake your own legal representation, undertake easier business decisions. You will have easier taxes. You can perhaps even claim more deductions on your taxes. There's all kinds of opportunities. The threats, whether intrinsic or external, are different also for a sole proprietor than for a corporation. Ultimately, the greatest threat to any business is its employees, because these are the people that produce the products and services. And if our quality falls too low, we will lose clients. If these employees are not adequately trained, ourselves included, we will not actually be able to undertake our business. The most intrinsic threat we face must be addressed by our business organization. If we have many employees, it may make sense to take a close look at how we hire them, how we work with them, whether they're partners, whether they're contractors, whether they're employees, whether they have any ownership in the business or in their products and services, how we are investing into them, what is their legal infrastructure as well. We also have to look at how we are able to adapt to our threats in terms of our organization. If COVID-19 hits, if there's a fire, if there's a flood, if there's robbery, how does each business model react to that? If we face these problems with or without insurance, if we face these problems with or without legal liability waivers, if our defenses fail, what happens? So we have to look at not only the opportunities for how we're going to engage with others, but also how others engage with us. Ultimately, the most important asset of any business is its quality. This is our reputation. And when we look at the value of our employees, of ourselves, and how we produce this reputation, we understand the vital importance of investing into our workers, into our skill, and continuing our development as we get better. In beginning your own business, it is extremely likely that you will discover that there are many subjects which I have poorly developed or did not explore with you at all. The intention of this course was merely to be an introduction. It lies upon you to seek the assistance you require when, despite a cursory understanding of the principles and theories of your business, you encounter a situation for which you are unprepared. The lesson of quality control is that good enough is good enough, and in estimating the quality of your enterprise, do not hold yourself to too high a standard. Rather, take confidence in your basic competency. I have no doubt that you will succeed.